So welcome to the entry strategy playbook. This is going to be the entire system into one visual framework. So this is going to be the whole SMCX system, just summing it up, making it easier, simplifying it for you guys to just make it even more and more digestible. You know, the more times we can go over the same thing in different ways and simpler ways, the more it can start to make sense. So it's going to have a three-step formula: the bias, the key level, and the lower time frame confirmation. Those are basically, if we sum up the whole strategy, it's made into those three aspects. So first of all, let's start with bias. Determining the bias, there's only three different aspects of bias. It's either in continuation, there's a reversal, or it's in indecision. And these are three questions you can ask yourself. If it's in continuation, did it break a previous structure, a previous high, a previous low? Then it's in continuation. Did it sweep a key level or sweep a previous structure, high or low? Then it's in reversal. Is price consolidating? So if price has not swept a high or low or broken a high or low, it's in indecision, and that's showing you the market is consolidating. And then we want to obviously wait for more details. So continuations are when price is breaking a previous high or low. And if it's breaking the previous high, then basically it's continuing to the upside, and this is just showing momentum. If it's breaking the lows, continuation to the downside. So continuation is quite easy to figure out. And we've got our reversals. Did it sweep a previous high or low at a key level? So when price comes to a previous higher time frame candle high or low, and it sweeps that low, this is our reversal signature. So this will let us know that the bias in the market is actually reversing. We've gone over this a lot, but it's just nice to go over it in new ways. And this is our indecision setup. So you can see if we've got a higher time frame candle. So let's just say these candles are 4 hours or daily candles. If price is kind of in the middle, this is also known as an inside bar because this candle is inside the low and the high of the previous candle high and low. So this is showing us consolidation. If we get this setup, we actually don't want to enter these trades. You want to wait for either a high or low to be taken out, because this is just showing us that there's low momentum in the market. Consolidation is just showing that the volume of the buyers and the sellers is very low, and they've kind of equaled out. So we want to wait for confirmation of either the high or low to be taken out. If the high is taken out, it can either form continuation or reversal. If the low is taken, it can either form continuation or reversal. So when we see indecision, then we just want to wait for confirmation. Then number two, key levels. So identifying key levels is a big part of the strategy, and identifying those levels where price will have a high probability of reacting or reversing at those points. So we can use fair value gaps. We can use higher time frame candle highs and lows. This can be our weekly candles, our daily candles, our 4-hour candles. The higher the candle, the stronger the level will be. So a monthly high or low, a weekly high or low are going to be stronger than a 4-hour high or low, for instance. And then we've got our order blocks, which are also known as opposing candles, or our CISDs, which I will break down into more details. So these are just key levels that when price comes to a key level, whatever key level that you like to use as your confluence that you feel comfortable using. I love using swing highs and swing lows and fair value gaps. So whenever price comes to this key level, that will be one of the criteria we look for. And these are some of the key levels I'll break down for you. So we're going to have imbalances or fair value gaps. There's internal and going to be external. This is going to be external imbalance or external fair value gap. You can see price reaches a fair value gap, forms a sweep, or we get our entry signature at that key level, and then we wait for the break of the CISD. And that's basically all we're looking for. We wait for price to come to a key level, one of these key levels I'm going over, and then we're looking for the formula to happen in that key level, either the swing high to be formed or a swing low to be formed. We get the sweep, we get the CISD break. That is one of the keys that we look for in this formula. Then we also get an internal fair value gap, where you'll see price will react. You'll see at this point we're getting a reversal, and then we get this big engulfing candle, which is showing displacement. Maybe this could be the first displacement we notice. That's price has shifted from either being bearish to bullish. we get this big displacement, and then we get the fair value gap, then price can react at that internal level. So this would be an internal fair value gap. And then we would wait for a swing low to be formed on that internal fair value gap. And then we look for our continuation entry. Or for the downside, you can see we get a nice move down to the downside. Remember, whenever we get fair value gaps being created, it's usually based because of displacement. And displacement is going to give us a very good sign of who is in control in the market. If we're getting bullish displacement, it's showing us that the bulls are in control. If we're getting bearish displacement, it's showing us that the bears are in control. So if we get this bearish displacement, price likely retraces to fill in that imbalance. And then if we get our entry signature, which is a swing high being formed in that level, that becomes our continuation entry to the downside, because we've identified now that the bears are stepping in because of these bearish displacements that are being formed. Another key level we look for are higher time frame candle highs and lows. So these can be our daily candles, our weekly, or even monthly candles. And then if price comes to those levels, either two things are going to happen. It's going to be continuation. If it breaks the high with strength, and the candle body is closing above the high, that's going to show continuation of these highs or lows of these higher time frame candles. And over here, you can see this will be either daily, a weekly, or a monthly candle, and we mark out the high or low. If price breaks the low, closes underneath that low, this is continuation to the downside, and this is showing us that this is a bearish state. Price is in a continuation to the downside or a continuation to the upside. But we're using the higher time frame candle highs and lows as areas of confluence to look for either continuation or to look for reversals. So this would be the reversal aspect. Price comes to the higher time frame high, and then we get a failure to displace. We get this rejection into the high. That is showing us a reversal. If price comes to the low and get the rejection, that's showing us a reversal. So these are going to be your monthly highs and lows, weekly highs or lows, daily highs and lows. You just go to a monthly candle and you can mark out the high or low, or a weekly or a daily high or low of the candle. And these are high probability areas where liquidity is resting, and oftentimes we can get price reacting off these levels. So that's just another key level to keep in mind. And then we can also use order blocks. Order blocks are also what are known as the CISD levels or opposing levels, order blocks. These are all one and the same. Once you can identify these levels, which are basically the CISD, it's known as the CISD after the sweep, but if it comes after the CISD, then it's known as opposing levels or order blocks. So it's all just the same term that people use, but it's basically all the same thing. It's just identifying, when we get a retracement and that retracement is broken. That is basically an order block level, but I will go into more details about these on the charts as well. Okay, so those are the key levels. Then we dive into number 3, which is the lower time frame confirmation. Once we've got step 1 and step 2 in place, then step 3 becomes really easy. We're just looking for either two forms of entry. We can either enter on the CISD entry, or we can wait for the fair value gap after the displacement, which comes after the CISD. So you'll see we'll either enter on the break of the CISD, or we'll enter on the fair value gap left behind after the CISD break. So oftentimes when the CISD is broken, it's broken with momentum, because we want to see a displacement or manipulation occur at the break of the CISD. When we get that manipulation or displacement occur at the break of the CISD, oftentimes, not always, but oftentimes price will retrace back to that fair value gap. So we have two fantastic entry opportunities, which I will break down into some details. So the first entry, on these examples, I've shown these higher time frame candle highs, but this could also be a fair value gap, or it's just representing a key level. So when price comes to a key level that we've marked out, or that we like to look for, we want to see a failure to displace or a sweep at that key level. Oftentimes when we do get a sweep, we're going to get a CISD that's left behind. That CISD is that marker that lets us know if price breaks that level, there's now a change in the state of direction of the market. And this is our high confluence entry zone. So in this example, price comes, it sweeps out the high of the level, we get a CISD break, and then we can enter on the break. So that would be entry number one. In our bullish example, you can see prices come down to a low. It's forming a failure to display, so it's sweeping out the low at that point. You can see we mark out the CISD. We also notice the manipulation, price moves away and moves back, which is that V formation we've gone into in the training sessions. And then as price breaks the CISD, we wait for the candle close. If the candle closes over the CISD, that becomes our entry. And then we can target either the high or the low or relevant liquidity area. But it's important to enter on the break and candle close of the CISD, because many times I've seen that price will break the CISD, but then it will not close below it, and you'll actually get a rejection candle, and then it'll come back and close above the CISD. So the CISDs can be very strong support and resistance areas, and price can either find rejection and resistance, or it can break through and then move to the next level. But these are some of the most important levels on the chart when it comes to entries, and I haven't found a better entry signal. And then we've got our second entry, where it's the fair value gap after the displacement. So basically, if you miss the first CISD entry, you can enter on the second entry on the fair value gap after the displacement, after the CISD break. So you'll see price comes down, it sweeps a low at a key level, it forms the CISD, and then it breaks the CISD. So if you don't want to enter and you want to wait for the retracement, oftentimes when it breaks the CISD, it will form displacements. You'll see displacement is often accompanied by this break of the CISD, because it takes manipulation, the manipulation of price going down and coming back with, it's forming this strength of volume, which leaves behind these imbalances. Oftentimes price will retrace back to this fair value gap. So that will be your second entry. So first entry is going to be on the break of the CISD. Second is going to be when price retraces to that fair value gap that was created when price broke the CISD. And that would be our second entry point. Here in a bearish example, you can see price reaches the key level. We get the failure to displace. CISD is formed, breaks the CISD. When it's forming that manipulation down that breaks the CISD, it leaves behind a fair value gap. Price retraces into that fair value gap, and that becomes our second entry point. There are, of course, more entry points, but this will be catching the reversal, and this is the aspects that I've mainly focused on. If you want to focus more on the continuations after this reversal signature, I'm going to be creating another section going specifically into those continuation entries and going into detail on how that works. So there are two entries you can take when you're catching this reversal. It's either going to be the entry at the CISD, or it's going to be the fair value gap entry, which is the displacement caused after the break of the CISD. So keeping it super simple, keeping it mechanical. So let's go into some more details about these entries. So the first entry is going to be the CISD entry. And these are the keys that we can look for. Number one, we want to see a sweep and a failure to displace happening, because this is our reversal signature. And then we want to see a sweep occurring at a key level. That key level will be a fair value gap. It will be a swing high, a swing low point, a higher time frame high or low, whichever key levels that we've gone through multiple times in this course that you like to use. So we just want to see a sweep occurring at a key level. And then number three, we jump onto a lower time frame and we look for the CISD entry, which is the break of and close of the CISD. So breaking it down into more details, this is exactly what we want to look for. We want to see price approaching our key level. Once it approaches the key level, then we want to wait for our failure to displace happening at that key level. Once we see the failure to displace happening at the key level, the sweep, then we're marking out the CISD and we're just waiting for a break of the CISD. When it breaks, it closes, then we simply enter. So we're keeping this entry model very mechanical. We're waiting for very basic criteria to happen. Once all the components happen, we're not thinking too much or second guessing too much. We're just simply entering at the break of the CISD. Bear in mind that we've got all of these components happening, and there are certain criteria we can look for to validate the setup even more. One of the ones that I look for is when you get the sweep occurring, the main thing I look for is how strong the aggressive move up is and how strong the aggressive move down is. If it's a strong aggressive move up and a strong aggressive move down to break the CISD, forming this displacement, you have a very high probability that now the market is going to go down. So we want to see the strength of the manipulation just before the CISD break happens. So we get manipulation up, causing the sweep, manipulation down, breaking the CISD. If we can see that with aggression, that's a stronger confidence for us now that this is going to be a very good entry setup. Now for our long entry, basically the same thing, just inverted. We wait for price to come to our key level. That key level can be a higher time frame low, or it can be a fair value gap, or it can be a swing high, swing low. Whatever key level you like to use, price will come to that level. We want to see a sweep at that level, higher time frame sweep. Once we see a higher time frame sweep, we get the CISD that's produced or created. And then we want to observe how strong was this manipulation that caused the CISD. You can see aggressive move to sweep, aggressive move back to break the CISD. That's a stronger confirmation for us. And then we're just waiting for price to break the CISD and to close over the CISD. And that's going to give us strength and confirmation and make us feel confident. And then we just simply enter. Where there's no more second guessing. We enter, we set our stop loss, and the higher probability of it going in our direction, it is much higher than it not. If we follow all of these steps without skipping a step, and most importantly, just observing that manipulation V. This is the key that I pay a lot of attention to when we zoom into our entries, is this aggressive move that basically it's the opposing candle that the CISD is created from, the aggression down and the aggression back. The more aggressive we can see down and back to break the CISD, the even stronger the confidence will be for that entry. And now for our second entry of using the fair value gap. Number one, we want to see a sweep or a failure to displace. We want to see that sweep occurring at a key level. We want to see the CISD break with displacements. And then we want to enter on the fair value gap after the CISD. That's basically the same steps as before, just one extra step. So you can see price comes to our key level, whether that's our fair value gap or it's a higher time frame high. We get that failure to displace of that key level. The failure to displace is basically the move where we get this aggressive run up and this aggressive run down. That whole move is actually what causes the failure to displace. And that is basically our entry signature that we're looking for, specifically in our key level. Once we see this aggressive up to sweep, aggressive move down to break the key level or the CISD level, then we basically mark out our fair value gap, and then we wait for price to retrace back to that fair value gap, and that becomes our second entry point. In our bullish example here, you can see we've got price coming down to a key level. It sweeps that key level with aggression. You can see this nice big aggressive candle, and then it basically breaks the CISD. And then when it breaks the CISD, it forms this displacement. We wait for price to reverse or retrace back into that fair value gap, and that becomes our entry points. So we can catch that continuation entry, either targeting the highs over here or relative liquidity. But it's just one other piece of the puzzle we've added. Instead of entering here at CISD, we're waiting for price to retrace into this fair value gap that was created at the displacement break of the CISD.